Hello, everyone. This is Noah and John, and we are from UrbanDigs. And today we're talking Manhattan. John, we're going to be talking rentals specifically today. And
Good.
we got Adrian Savino, who is the director of leasing and business development over at Living New York.
hmm
Okay, great pulse on the rental market. He's gonna let us know what's going on. And Adrian, I want to get right to it.
Sure.
So we got a lot of agents listening. What's going on? What's happening? Where's the rental market at?
Yeah. Well, first, appreciate you having me. It's been a long time coming. I think we've been talking about it for about a month now.
Yes.
So it's been nice to be on. I appreciate you having us. So just kind of diving in, referring to, let's talk about last month specifically. We saw about 7,500 leases signed last month in the month of May, which is great. Obviously, those numbers are trending up from the COVID lows. About 60% of those, 4,500 roughly, were in doorman buildings. So I know we were talking about kind of the affordable luxury segment, but we're seeing a huge move from people that were, currently living in walk-ups or living in walk-ups that decided to stay in the city, move to this affordable luxury segment. They saw prices dip, they saw concessions come up, and they thought, why not trade up for, a higher end version of what I'm currently living in. Some stayed in their neighborhoods, some moved to other neighborhoods. We saw a flight from certain Manhattan neighborhoods to Brooklyn and Queens, but overall, this is a trend that we were seeing throughout COVID. As we rebound, we'll see if that continues or persists, but that was something that we were seeing pretty consistently throughout the the last year or so. In regards to like overall inventory, we're seeing inventory around 15,000 units. That's just what's online, right? Like not everything is going to be represented on StreetEasy or some of the other platforms, but that's what we're seeing online, which is a higher number, almost 150% increase on this time last year. So those numbers are significantly higher. Absorption, we'll see how things go, but that's a lot usually to absorb across the city.
Right. And can you speak, Adrian, at all to concessions? Because I know concessions at some point were pretty drastic, and I understand they've come back, but I'm wondering what's the pulse on those right now?
Yeah, so I mean, again, just going back to where we were and where we are now, we saw concessions, top out around 4 months. Not every segment, whether it was the affordable luxury we just mentioned, smaller walk-up buildings, trying to kind of focus on the lower end of that spectrum. But when COVID kind of first struck, landlords were not really worried about upcoming units. They were worried about their current tenant base. A lot of them were worried about collections and tenant retention. So we weren't even initially focused on that. We were focused more so on helping our clients kind of address those immediate things. And then as we started to have units turn over, people leave the city, we had to kind of address concessions on a case by case. But we saw, range 2 months to 4 months, depending on neighborhoods. Certain neighborhoods got affected more than others. Midtown East, Lower East Side, East Village, neighborhoods that were historically more focused on the student population, young professionals that were, I think, sidelined in a lot of ways because of what was going on. Some of the kind of the service segment, like in Midtown West, where we had a lot of like theater district workers and bankers and kind of consultants that lived over in those neighborhoods that were working remotely. We saw buildings that were generally populated by those segments having to kind of rely on heavier concessions.
Yeah,
Right.
and are those concessions still there now, or are they quickly fading away?
This is a lot of this is case by case. We're seeing concessions strip away. We're trying to do it, for at least for our clients. We're doing 1 month per year in terms of renewal. So if we had someone that signed at 3 months upon renewal, we would try to renew them at 2 to 3 months. Right?
Gotcha.
We might try to renew them at 1 to 2 months. The market is rebounding pretty quickly, and we've seen this summer specifically. We kind of reviewed the overall signed leases, but we're seeing that the summer has been very busy, really since beginning of 21.
Interesting. Yeah. And let me ask about the beginning of 21, because, when we were putting out some rental reports, one of the things that we were noticing on the landlord side is that a lot of these leases were capped at a year. So you were getting a great deal in rent, you were getting some sweet concessions, but landlords didn't want to go past a year. And I'm wondering, is that still the case?
Yeah, most landlords are still seeing, as we're, we've bottomed out, right? So the pricing did bottom out. We're coming out of it, but most landlords only wanted to do 12-month leases because they knew that this was, a transitory, if as long as there wasn't sort of, some sort of a re, reigniting of, a new strand or something was coming out that was, affecting it where people were still moving out of the city. Most people were just looking to lock in. Most landlords were just looking to lock into, a year lease, not to lock in this kind of concessionary pricing longer than that period.
Really interesting. Adrian, would you agree that in the last 3 or 4 months, the rental market has kind of just shot up like a rocket?
Absolutely. Absolutely.
Okay.
So,
And go ahead.
Yeah, we've been seeing, an entire year of supply that kind of got held over into this new year, and then traditional turnover where, we would already have this inventory. So the combination of having units left over from 20, then rolling into, normal turn for 21, we've seen, in terms of signed leases that they've really skyrocketed. So on a personal level for living, we've already, completed our entire 2020 calendar year, year to date in 21.
Wow. That's incredible.
Yeah.
I mean, what I'm thinking is here, we're about to start a positive price action quarterly sales cycle on the sales market.
Sure.
With Q2. So we're going to start to get some headlines that Manhattan prices are coming back. And that's coming right when the rental market has just, again, shot out like a rocket the last 4 months or so is what I'm hearing from a lot of my contacts. Yeah. So what do you tell landlords? What do landlords do over the summer?
We tell landlords the same. I mean, everyone's trying to take advantage of the rebound as people come back. As you hear these bigger banks, bigger consulting firms, bigger tech firms. Everyone's passing guidance on a rough estimate of September to come back to work. We think that this is going to continue into the fall and winter. Generally the sales cycle is a bit different. Fall winter is a bit busier. The rental cycle is generally busier in the spring summer. So I think we're going to see an extended summer rental period into probably the end of 21.
Interesting.
Where historically things would drop off September, October, and be slow until that subsequent March. I think we're seeing that the rental market will persist through through the beginning of 22.
It's interesting, because usually the rental market leads the sales market, but it almost seems like the sales market has led the rentals market because it picked up, blew through the winter, and has just only recently started to show signs that it might be topping out. But I mean, if you look at the just in terms of the sales market, the weeks from March all the way through the end of early June, mid-June 14th, the week of June 14th, every single one of those has been one of the top 20 deal weeks since 2004. It's just amazing. The only exception was Memorial Day. And it seems like now that the rents are catching fire. But, on the sales side, the question that we get a lot from agents is, hey, listen, where are the deals? I have, how do I convince my buyers that there's the COVID discount of, 20, 30% is actually not the case? And I'm curious, on the rental side, what do you do about those opportunistic renters that are thinking that I can already get a huge cut in rent and I want 6 months concession?
Yeah, so I mean, our position in the market, we kind of sit between landlord, developer, and the renters. So we kind of have to play devil's advocate. We need to keep velocity at a certain point to keep these buildings filled, but we need to do so at reasonable rates and reasonable concessions. So we had to bring like we do historically, whether it's sales or rentals, we have to bring both parties together to figure out what makes the most sense. Some landlords are more flexible, some are not. Some are, their basis is different than others, their debt is different than others, their positions are different than others, the return kind of expectations are different than others. So it really depended on what kind of landlord we were dealing with. Some were contingent on cash flow and just wanted to get renters in the door. Others were contingent on keeping gross rents at a certain point and offering heavy concessions. So not the best answer because it's painting a broader picture, but it really was a case by case thing for us depending on our client.
Yeah, no, it's an idiosyncratic problem, right? I mean, every renter, every landlord has its own key, but it sounds almost like that, if you were to sort of rewind and you put yourself in landlord shoes of, say, September, October, they were not saying no. It was just bring me someone who can sign something at a reasonable rate because I got to cover my costs. And now you have some landlords who have a chance to say, you know what? No, I'd rather pass.
Yeah, the power is shifting back, towards the landlord.
Right.
We even saw interesting data points on qualifications. Generally you want to see on the rental side people that are making 40x a monthly rent and have credit, above 700. The landlords, because of the demand dipping off so much, they were having to accept, deals and individuals that were not, traditionally or historically qualified.
Well, I mean, really, really interesting. Adrian, is it safe to say that the rental sector since COVID dropped about 10-15% in terms of pricing, and then you had an additional X% with concessions? Is that a fair assumption?
Yeah, I mean, a lot of these were dipping off or topping off, around 25 to 30% with concessions considered. All right, so you had
Okay, so 25-30% net effective. So okay, and it was probably a 50-50 split between rent coming down and concessions. Is that a
yeah,
fair
a lot
statement?
of times you'll see, maybe not 50-50 exactly, but a split between drop off in gross number and concession offering.
Okay, here's my question. If the rental market has rebounded and come back to the point where the concessions are fading, right? It's also probably fair to say that first the concessions go, then the rents rise.
Yep.
That's usually the flow.
Yep.
Are we still seeing rents down 15%? So we haven't seen rents rise yet, is my question really.
Yeah, to your point, usually concessions are burned off, and then you'll see an increase on the gross rent. Some are doing both, nominal increases on gross, 5, 7%, as leases turn, and then they'll try to get, again, if they were doing 2 to 3 months, they're doing 1 to 2 months now. So they're trying to kind of combine those two things, but generally speaking, you'll try to burn off the concessions first, and then look to increase gross pricing second.
Are they getting those 5 to 7% from year ago leases, or successfully right now?
Yeah, it's dependent on neighborhood. I know we talked a little bit earlier about Midtown East and Lower Manhattan on the east side, but neighborhoods like Greenwich Village, West Village that historically have more established renters, those were less affected throughout the period.
Here's why I ask, because it's a complete sentiment change. If you go back a year ago, I mean, we were kind of falling into it, right? And now we're kind of the complete other way. We're going out of it. And when I look at ground floor retail and I look at the rebuild or the recovery of New York City, I think that's going to greatly impact the rental sector. And if I'm looking forward, which I like to think markets do, I know the stock market looks forward and discounts. I don't know how much the real estate market does. But if I'm looking forward as an investor, we're getting close to that recovery of ground floor retail and commercial coming back now, with the wave of businesses now starting to bring employees back. I mean, what do you think in that regard?
Yeah, I think a lot of the bigger tech firms and banks and consulting firms are setting their sights on September for kind of a recovery. We're seeing numbers hover around 20 to 25% in terms of office occupancy. So that's increased from last, I say 3 to 4 months was closer to 10 to 15%. So we're seeing an increase on those numbers, and we're seeing kind of a trend to come back. There's going to be a hybrid schedule. There's going to be people that are working from home, twice a week, once a week. But overall, I think that the city will see people come back at least in some capacity. The narrative was, let's reduce office footprint, let's reduce retail footprint, because we didn't know when the recovery was going to happen. But I think most people didn't think it was going to happen as quickly as it has. To your point.
It's interesting. So let me ask you this, because I think Noah touched on an interesting little thread I'd like to pull on, and that's that when you look at the sales market recovery, a lot of the recovery was in the what you would call the residential areas. So like Upper West Side, Upper East Side actually saw really interesting sales numbers, compared to say Midtown and Midtown East, things like that, are still sort of struggling. And a lot of it has to do with exactly what you're talking about, Adrian, which is we're still waiting for storefront retail to come back, office to come back, and to go back to what Noah's earlier question was, are some of these landlords getting these price increases? I'm wondering, is it possible to break it down by neighborhood to say it's much more? And you mentioned the Greenwich Village, but I'm curious about some of the larger residential neighborhoods like the west side, the east side. Are they a little bit more stable in terms of rents versus say Midtown?
Yeah, I mean the vacancy rates. I'll go back to the specific neighborhoods, but the vacancy rates we saw the highest were in Midtown East, East Village, Lower East Side. Those were commercial neighborhoods or contingent on students, young professionals for the most part in terms of renter base. The rest of the neighborhoods, I would say, were stable. There was a little bit of a dip in vacancy, but for the most part, it was stable. There was a little bit of a dip in vacancy, but for the most part, it was stable. There was a little bit of a dip in vacancy, but for the most part, it was stable. vacancy at lowest rate we were seeing in like Battery Park, Financial District, Greenwich, and West Village. Again, those are historically, stronger renter pools, renter bases, so those were less affected and less transient.
Mhm.
But I think you're going to see that kind of rebound across the board. Midtown will probably be the last to, given it's not as residential as other neighborhoods throughout Manhattan and Brooklyn. That'll probably be the last area to rebound fully.
Right. So
And
let me
John,
yeah, go ahead.
just to add to your point, I want to add to your point. It's almost like we could see ahead what's happening here as well. Like if you think about how the sales market, the next 2-3 quarters, we're going up.
Right.
The rental market, the next 2-3 quarters, we're going up. Like we could see in the future. Cap rates, I wonder what's going to happen with cap rates. Is that equation going to change? Because cap rates, if you think about what they've done, there's no value in New York City from an investment standpoint, right, Adrian?
Yeah, I mean, it's tough to say. I was actually listening to Peter and the Marcus and Millichat team on Behind the Bricks, and they were talking about the cap rates compressing more so. It's a lot of people, from the investment sales realm, we're looking to other markets to find, yield, and I think a lot of them are going to start coming back. A lot of people are looking in Florida, the Sun Belt
Right.
state, the West, the West Coast, and it seems like a lot of them are seeing that New York is rebounding, and if you can get a 5 cap here versus a 5 cap elsewhere, why would you look for ancillary markets, or I should say look to ancillary markets?
Yeah. Yeah,
Right.
and I really wonder, and I think we're nowhere near a 5 cap, but I mean if we're at a 1, or some even questioning that with the net effectives on rent because we couldn't measure that real accurately. If we can get up to a three handle on that or a 4 handle on that, then very attractive, and those investors will come in. And
Yeah.
that's something that hasn't happened yet, and that's another thing that could just buoy this whole market. That's what I'm saying.
Yeah, 100% agree.
Yeah, and I guess I'd like to kind of round this out, but and it's a great segue is to talk about if you're looking at this market from a future perspective, which we were just talking about, like how do you? We've already seen what I would say is pretty much the worst that could happen. A pandemic coming in, hitting rentals at a period in time in which most of them are coming vacant anyway, right? The summer, and then having rents get hurt. It was pretty much a clockwork perfect storm. And I'm wondering the lessons learned, like you talk about the vacancy rates that are higher in the East Village, which I don't think many people would have predicted through this. So we've had a chance to shake out a lot of the bugs here. How are landlords going to go about future proofing this? And are they going to make any changes to the way leases are structured? Or is it going to be less reliant on a summer season? Is it going to be a more diverse mix of tenants and buildings? I'm just curious what the thought, if you know what the thought on landlords is there.
Great.
Yeah,
question.
absolutely. I mean, for future proofing, there's again, there's different building types. If you're talking about walk-up building versus luxury building, getting creative with your space, getting creative with your lease terms, getting creative with your requirements. A lot of landlords, again, to kind of reference something we spoke about before, requirements were very rigid in the city. Landlords kind of had the power in that regard, with companies like the guarantors, Rhino, Obligo, that are giving they're giving coverage for renters that wouldn't have access to apartments beforehand. They're giving security deposit replacement options. They're giving access to a new, to speak to your diversity question, they're giving access to people that didn't historically have the option to rent in some of these buildings. So that's been an interesting kind of transition on that front. In terms of the buildings themselves, we're getting pretty granular with our owners on how to add value. If cap rates are at a certain point, you need to look to how you're going to add, kind of squeeze more value out of these buildings. Yeah. I think there's going to be a focus on shared office space within buildings, smaller kind of like cut up offices that you can go to during the day. If you're working from home, twice a week, it'll be nice to, leave your kitchen or living room or bedroom desk and go to a small common space within the building to work for a couple hours just to break up the monotony. So we're seeing a lot of our landlords focus on, building out, smaller shared offices within their residential buildings, not to lease to third parties, but to just offer to their current tenant base.
That's a great idea, because when you think about, the idea that capital improvements are now completely restricted in terms of how you can recapitalize those, the idea that you could have something that adds value to the building, but then you can charge on top of because it's a separate thing is a very clever idea.
Yeah, and that can be something that can be hidden value too. You can, give it to the tenants free of charge as a, kind of a concession that's not monetary. Give it to them as a, free 1 year trial at the gym, or a free 1 year trial at our new shared office space, and you can start charging on top of that, in subsequent lease terms.
Good stuff.
This is great.
Yeah.
Adrian, this has been fantastic. We're out of time, but I mean, we're going to have you back, and this has been fantastic. I just want to ask you, I mean, we've been talking about a lot of interesting future positive trends, macro kind of things. Are there any risks? Let's just be open here. Are there any risks to any policy changes that you see maybe ahead, or anything that could derail what we think is a recovery that's just beginning?
We'll see. I mean, the primaries were yesterday. The official vote will be in November. So a lot of that, if Eric Adams, continues to be the front runner, we'll see what his promises, what he upholds. So it depends on a lot of it depends on the mayoral race. Other, I guess, exposures for landlords are whether or not people do come back. They all do come back to the city. We're seeing those trends right now, but that's a 6-month sample size. We haven't seen it over a long enough period of time to understand if that's going to be, a bigger macro trend.
Yeah, what a fantastic answer. Thank you for mentioning the sample size and being completely transparent on that. We have to see if this continues, and that's a great answer to that.
Absolutely.
So, Adrian Savino, this has been fantastic. Director of Leasing over at Living New York. If you have any questions for him, just where to contact. Great episode. Thank you so much. That is John Walkup. I am Noah Rosenblatt. We're both of UrbanDigs. This has been Talking Manhattan, and we'll catch you next time.
Cool. Thanks, guys.